Hey all, welcome to today's session. I'm Ruchi Vora. I'm a program manager at Headstart. So today's session is all about how to negotiate your term sheet. Before that, let me talk about Headstart and WaterBridge Ventures that we are partnering with. Headstart is the largest and oldest startup community, and we are present in 25 cities and 3 different countries. We run various initiatives such as one-on-one mentorship sessions, the current knowledge series sessions that we're running today for startups. We also support incubators and accelerators across the countries. For this session, we have partnered with WaterBridge Ventures, who are an investment firm helping early stage tech startups. And they have come up with a fast forward program and would like to discuss on a very interesting topic, that is how to negotiate your term sheet. So when you say term sheet, in a very simple language, is a non-binding document outlining basic terms and conditions of a potential business agreement. And this can be further negotiated between a startup and an investor. So this topic is today led by Mr. Naman Kejriwal. He's an investment associate at WaterBridge Ventures, previously a private equity analyst and an investment banking associate. While you hear this program, also apply for it. And the crux is, if you write Headstart in the question where they asked, how do you hear about us? Your application gets prioritized. So over to you, Naman. I'm currently sending the link of the event, also about the form, to get more details about it. Naman, over to you. You can go ahead, start, and you can take the presentation of the screen.
Hey, thanks, Ruchi, for the introduction, and thanks, Sanjana, for organizing this. Stoked to meet you guys. I see some familiar faces here, and it gives me immense pleasure to be able to share what I know about the industry with you guys, as requested, and as I keep it, like I'll keep it very casual, very layman, and we'll try to get into the how I have done my CA examinations. I'll just help you get to the bottom of the things. Why is the provision originally here? Why is the provision originally designed, so that you will be able to understand how to negotiate it? Because if you know the crux of it, only then you can be able to negotiate it better. So I'll quickly do that. I'll just present my screen. I'm in a short presentation. I hope everyone can see it. So I'll just get started. I see some people are still joining, but they'll catch up from where I am too. So the today's topic is how to negotiate your term sheet, but I'll rather focus on what is the term sheet, what are the key clauses, and why are they placed there. So as discussed, I am the associate at WaterBridge Ventures. I was born and raised in Surat. I did my 12th standard from there till there, and then decided to pursue chartered accountancy. I was a merit holder across the levels. I also cleared CFA level 2 examinations. And experience-wise, I have experience across the spectrum of investing. I started my career with public equity. I was a buy-side analyst there, and then wanted to get to the private side of the thing. So did investment banking for a year, and also have been in a private equity environment. And currently, I'm associated with WaterBridge Ventures, which is an early stage. We invest in early stage startups, which is generally seed, pre-series A, or till series A. We do check sizes up to $2.5 million. And the role is based out of Delhi, and we have offices in Bangalore too. So that's a quick brief about myself. So I've had like 3+ years of experience dealing with term sheets off the bat. So that's quickly about me and about the fund. So these are some of the investments we do. It's some of the star performance for WaterBridge Ventures in the past. It has been Unacademy, Magic Pen, which Zomato recently invested in business, where WestBridge recently invested in Atlan, which is a data stack company, and Chalo, which is a mobility company based out of Mumbai. Doubtnut, again, doubt solving application with more than 30 million downloads and users. Setimol and OneCode, both in assisted commerce. So this is a quick, brief portfolio of ours. For a larger understanding, as I mentioned, our check sizes are till up to $2.5 million. And we have some 27 portfolio companies and 60 founders in our ecosystem network. So, and yes, there's a high value add concept. We believe we are very founder first company and founder friendly company. And for us, to analyze the company, also founders pays much higher percentage than we look at the business models or or the traction, etc. So founders are super important to us. We generally have a typical long relationship with them, 5 to 7 years. It's generally how it's take from an early stage to an exit. So we work very closely in harmony, and yeah. So that's about us. So I'll stop boring you guys and get to the topic. So what exactly is a term sheet? As Ruchi also gave a brief, so I'm understanding most of the people will have a fair idea of it, but just to do the basics, it's a non-binding agreement that shows the basic terms and conditions of an investment. So the non-binding is super important because it's neither binding for the investor and neither it's binding for the founders. When we say this, the basic idea of term sheet, generally when the term sheet gets issued is only after 2-3 calls with the whole investment team with the fund, and generally there is an investment committee IC meeting which happens, and post that term sheet is rolled out, if everyone or the IC community has done a voting and it's been decided that we are very keen on investing in the company, so only then is term sheet rolled out, where at least the investment team is sure that we want to go forward with the investment. But what happens is so the relationship of an investor and the founder is it's a very commercial relationship, and it needs to be properly documented, and investors' right need to be secured, because what investor provide is basically maybe funding, maybe one round of funding, 3 rounds of funding over the life cycle of an investment, but that's just binary one-time events. But the rights need to be secured throughout till the exit, right? So that is why the term sheet is a very important document for an investor, where the investor states down the basic needs while going through the investment. I will take you through every clause and why is that clause inbuilt, what right does it secure for the investor. So as mentioned, it does mention what is the company valuation, what will be the investment amount, what is the percent stake we are acquiring, what voting rights would we have a board seat or not, what will be the liquidation preference. I'll deep dive into every term, and what's the anti-dilutive provision, and what's the commitment, and some items that will be spelled out in detail also. I'll show you a draft term sheet. I'll in fact show you the WaterBridge Ventures term sheet, which we use in the fast forward. It's not a standard term sheet, which is always negotiated in every case-to-case basis. Yeah, I'll deep dive into that. And so once term sheet is accepted by the founders, it is followed by definitive agreements. So obviously, it's not a one go. I've seen version 20 of term sheet also, because it's an ongoing conversations, not between the investors and founders, but the lawyers of the investors and the lawyers of the founders too, because it also contains employment agreement, which an investor will roll out. Founders will be on employment of investors. So there are many personal commitments also. There will be reps and warranties. So the lawyers, personal lawyer also get involved at that stage. So once everything is finalized, and also a term sheet poses some condition precedents or condition before which, if only those conditions are fulfilled, and which every term sheet would have, which is typically a DD, which is a very standard clause in any term sheet, that the investment is subject to DD, and if the outcome of the due diligence, it will be a legal due diligence plus business due diligence plus financial due diligence, and also promoter due diligence, etc. So those are at least some due diligence which every fund will undertake. So if anything, any material event or material finding comes out in that diligence, then the term sheet is void ab initio. It's void ab initio. So this is something which I'm trying to highlight, that why it is non-binding for investors and the founders too. What's material event is always vague, and it will happen to remain vague, but it helps protect the investor when because after the term sheet is when the books of accounts are opened for the company, and the investors get to see the accounting system, the team built up, and it is only then that the investment team will deep dive into it, and obviously will hire agencies. That could be the big fours who will be hired for financial diligence. It could be the top legal firms who could be hired for the legal diligence or financial diligence, etc. So once everything is done, and the founders have agreed for the valuation numbers, have agreed that the rights they are ready to give to the investors, there is a definitive agreements, which is a much lengthier version of term sheet, but term sheet is the foundation for those master documents, which are the SSA and the SHA, which is known as the definitive agreements, which is the shareholder agreements and the share subscription agreements. Every clause is defined, maybe magnified, and it's a proper version which comes out in the SSA and SHA. And some more rights and liabilities are also discovered in the SSA SHA, which might not be material at the term sheet initial discussion stage, but shapes up towards the end. Generally, it's a master document, 100-page document each, SSA and SHA. So, and which is very crucial, because every time any new investment takes place, there's a new round, SSA and SHA of the previous round is what would be seen. So this is how important the documents are. So yeah, I'll help you know the terms, because each clause is diligently designed to protect the right of the incoming investors. So yeah, this also you can find on our website. This is our I'll just quickly tell you about the Fast Forward program also. So WaterBridge Ventures is running this third series of Fast Forward program. This is just dual agenda, giving speed to seed and democratizing the access to VCs, which is, I don't know why, apparently a really hard task in this generation. But our idea is that we will try to reply. We have it replied to all the applications we have received within 7 days with a specific feedback on if we will like to do a second call or we want to like to pass the deal. So this is how we are getting speed to speed and making all the applications counted and giving a platform to all the founders. So that is a seed program where we do up to $1 million checks. That's not up to a $2.5 million, because it's a seed program. We do up to a $2.5 million in pre-series investments. So in the Fast Forward program, we give term sheet within 30 days of the application. So our term sheet is pretty much available on the website. So if there is any negotiation, which the founder can start negotiation in the initial days itself. So this is how a typical term sheet will look like. There's a name of investor, nothing to know there. The name of the company, incorporation city, founder, I think, which is, but yeah, founders need to be defined, because sometimes there is a promoter, a managing director, or chairman in the company. But this is where it's because every founder will have a contractual agreement. So this is where it counts for the need to define the founders of the company. And investment amount, very specifically, it says up to $1 million, but this is just for arbitrary purposes. But the investment amount is fixed. Let's say WaterBridge Ventures will invest 500K in Headstart. Let's say the name of the company is Headstart. So that's super important, the investment amount. And there could be several versions of it, because not every transaction is not a plain vanilla transaction where there is just one investor and one investor investing in the company, but there could be a lead investors and many other small investors are also participating together. But always there's a lead term sheet. There is always a lead investor. It could be co-lead investor, but the term sheet is one, and every other party either agrees to that master term sheet and get their terms incorporated in the SSA, SHA. Every investor will seek some rights, like some basic rights, pro rata rights or anti-dilutive rights, which I'll come to later. But there is one master term sheet, which is generally the lead investor's term sheet. I'm talking about that specific term sheet. And so investment amount, which is a hard-coded number, valuation terms, which is again a hard-coded number, that maybe for 500K, we are valuing the company for $5 million, which is post money. So ultimately, WaterBridge Ventures will end up acquiring 10% stake in the company. So this is how the language is stated, which clearly says that we are valuing the company at $5 million post money, and we are investing 500K. We will acquire 10% stake post funding, post dilution stake in the company. And it could be equity, it could be CCPS or whatever. Even the venture debt also issues a term sheet. It's a very common name. It's not that only equity transactions. Venture debt team also will issue a term sheet. So that's the most important clause, because this will define the valuation of your company and the investment amount by the investor. Then participating rights. Participating rights is what I was talking about, is the pro rata, where generally the investor will reserve the right to participate in the next round up to their current holding. Let's say WaterBridge Ventures has put a term that we will maintain our 10% stake if we want to. We just take a right that in the next round, if whoever, say Tiger Global, wants to come in the next round, but we in our term sheet have secured that right that whoever wants to join the round, maybe we can discuss that later, but we will have the right to maintain a 10% stake. We'll do the additional top-up investment, what is needed, whatever the investment value, say the round is, you valuing the company at $50 million in the next round. Okay, we'll do our pro rata share, we'll put the additional amount, but we should have the right and not the compulsion to participate and maintain a 10% stake. So that's a pro rata right, that's the participation right. And on the top of that, some investors to also do retain super pro rata, that we have 10% stake, but we have a super pro rata right to increase it to 15% on our bill if we want to in the next rounds. So this is, and every term sheet is valid up to till next round. Whenever the next round comes, there's a new term sheet which comes in, new SSA, SHA which gets formed. So the terms have to be renegotiated then. So be mindful of that. Okay, there are 4 pages like this. I'll go quickly. So conditions precedent, CPs, which we you casually call in our language, is super important. Before CPs, completion of CPs, the signing of SSA, SHA doesn't occur. So post this term sheet, it's the term sheet is based on those conditions that we need to be sure of the incorporation of the company and regulatory approvals, that everything is fine there. Founders agreed for a full-time employment arrangement. Non-competition, the founders, even if they quit, they wouldn't go and start a new company with the same value prop what they're doing in the current company. Non-disclosure, IP development, etc. Legal DD, which I already touched upon. So this is important. And founder vesting. So the shares of founders are generally locked in. And so also I'll here try to touch upon how to negotiate. So 5-year vesting is pretty standard in the industry. So the clause is there to say that say, for example, if 2 founders hold 20% each, so those 20% are locked in and the founders are not allowed to transfer the share to any secondary party, because the investor will have their own share. Like in this case, the WaterBridge Ventures has 10% of Headstart, right? But the founder shares are also locked in so that they are not doing secondary transactions, they are not diluting their stake. So the shares are not vested. They generally vest in 5 years, 20% each in 5 years, and so that to protect the investors from selling the shares, because it could be sold to a competitor also, and also founders might be trying to get into different businesses, but investors need to make sure that their stakes are locked in and there's enough interest and they're vested in the business. ESOP pool, this is very arbitrary. Anyone can ask for any ESOP pool generation, but this doesn't really matter because the ESOP pools are generally created on the premise that maybe it could be a 20% ESOP pool, but generally it has a clause that any unfilled portion of the ESOP pool will directly go to the founders. So the founders generally carve out the ESOP pool from their shares, and it generally remains that share, and the ESOP gets allocated, vested only how much this is offered to their star employees, right? So that ESOP pool, WaterBridge Ventures asked for 10% ESOP pool. Before closing the round, we want 10% because it makes onboarding a good talent easier. So ROFR tag along, which is very important. ROFR is basically the right of first refusal. So there is a more advanced version of this right, which is ROFO, which is the right to first offer. So which says that whenever there is a secondary transaction happening, any investor who is selling any existing, so that could be WaterBridge Ventures, that could be InfoEdge, who is also sitting along with us. Any investor, if they're selling their shares, then ROFO says, the right to first offer says that the first offer has to be made to WaterBridge Ventures. And if the WaterBridge Ventures rejects that offer at the particular price, then only you can go out in the market, right? And similarly for founders, if the founders want to sell their stake, the WaterBridge Ventures, who is the key lead term sheet holders in this round, will have the right to have the first offer. So that's offer, right, ROFO. But for ROFR, it's basically it's the right of first refusal. So basically, the investor or the seller here can reach out to different parties and finalize the last offer, last price, and has to communicate it to WaterBridge Ventures that this is what they're looking at, and we already have an offer for this valuation. And only when the WaterBridge Ventures refuses it, they can go forward with their transaction. So basically, it's like a consent also. It's a written consent or and basically a consent before they do go forward for any secondary transactions. So that's ROFR. And because again, the investor can sell the stake to a competitor, the investor or the founder can sell the stake to a competitor or whatever. We need to be sure who is there in the cap table. So we secure this right. Even we might want to increase our stake, etc. Like we know what happened with Oyos of the world, etc. Right, where we need to know who is coming in the cap table. So tag along is generally for the minority shareholders. Every investor will keep the tag along right. So basically, it says whenever the majority shareholder wants to take an exit, the minority will have a tag along, and they will have to make sure that the minority investor is also exiting along with them. So the tag along right is to protect the minority interest, and the exit of minority happens along with the majority investors exit. So liquidation preference, which says 1x here, we are very humble in that sense. So in the negotiation, maybe in founder vesting, you can say that no, you want 4-year vesting, but then always it will be based on subject matter and facts. So it would be based on subject matter and facts that why do you want 4 years, what is the intention, etc. For liquidation preference, we have 1x. It means that this term sheet giver, like WaterBridge Ventures in this case, will have the right to receive the capital at the time of liquidation. The first outgoing of the fund will take place to WaterBridge Ventures. They will receive 1x to what they invested back when the investment happened, and then any other shareholder will get any remaining sum of money. So that's liquidation preference. Board seat, yes. Obviously, you have seen all those Facebook movies, etc. Who is sitting on the board is super critical. Board has humongous powers and the power to oust the managing directors and CEOs too. So yeah, we are, as we say, we are super high value construct. We are super curated in our approach. Also, we try to take a reserve a board seat and an observer seat also. It's up to us. We want to take a board seat or take an observer position, but there has to be our involvement in the board, because all the major decisions takes place in the board. And if you can't be on the top of the company's working, you don't have the board seat. So that's also right, which is not a function of shareholding. A 5% investor can also ask for a board seat. A 50-20% investor might also be ready to forgo their board seat. Not every investor is ready to get on the board, because it comes with the contractual obligations also, and time bandwidth commitments also. So you will rarely see Tiger Global asking for a board seat, right? But observer rights are safe. Everyone takes the observer rights. They can join in where they want, but it comes without contractual obligations. So that's there. Exit rights, standard exit mechanisms. I think this you can skip. This is very documentary purposes. And reserve matters. So here comes the key rights. Investors allow founders to take all the major decisions, but reserves the right, as in any judgment on this matters will only take place after a written consent being received from the term sheet giver. So whenever there is a debt raised, generally up to above a certain amount, here we have not mentioned, but we would be even asking for, or even we wouldn't appreciate if the founder keep coming to us for every debt raise. But above certain amount, if there is a debt being raised, we like to know, and we like to keep a reservation there, and only happens after our written consent. So amendments on the company's constitutional documents, whenever there is a change in the memorandum of associations or key changes in the article of association, we would want to know beforehand, before the changes happen. Change in the composition of company's board of director, obviously it's a reserve matter for any incoming investor. Any ESOP grants greater than 1%. So this is very liberal term that, there's a key employment hiring where you want to give more than 1% of your company to someone. So we would like to be involved. We like to know who the person is and what value addition would take place. Significant expenditure, merger and acquisitions, obviously minding of proceedings for insolvency and bankruptcy is where the investor would like to step in. Disposal, transfer of any dealing with IP assets of the company, etc. Standard information and inspection rights. They are the AMA matters where we would want that we have the rights to inspect the books of accounts by visiting the company's place whenever we want to, and access to MIS, which is investors' right. MIS is obviously a monthly information system that we would want access to at least those basic rights, so that we are updated on what's happening around. And there are many standard information inspection rights which we take, but they are generally for bookkeeping and for us to be on top of it. So deal expenses, as you know, there would be several diligences which happen. Either it could be, mostly it is sponsored by companies, uh, and but somewhere, but it comes with a clause that no, if the deal falls off, then generally it is borne equally by the investor and the company. So we cap it for 3 lakhs because this is in benefit of the founder, that we won't we will, so we are the one basically who will hire the DD agency, be it legal DD or financial DD, and but we will make sure that the expense for the company doesn't go above 3 lakh. So this is very liberal term, because any big four or any big organization will generally ask for a, a 5 lakh kind of number. But as this is a seed program, not much to do diligence in the companies that we come in, etc. So this is why this has been capped at 3 lakhs. And valuation protection, anti-dilution, which is another super important clause. So this is in the case of down round. Let's assume we valued this company at $5 million in this round, and the check went in. But what if the next round happens at the valuation of $4 million? Right? This is a down round. So what will happen? The next incoming investor will have more favorable rights. Will invest maybe 400K and get those 10% for which we paid 500K, right? And we came in early, took the higher risk, etc. So what happens is anti-dilution protects us from that. Anti-dilution says that we will take the next round valuation or the current round valuation, whichever is lower, as our entry valuation. So it would be assumed that the 500K was invested at a $4 million valuation, and our stake will retrospectively increase to 12% or 13%, whatever the number is coming to, and the founder has to take the hit. So this is something which the founder has to compensate from their pie of the things, to protect the rights of an existing investor whenever there's a down round. Obviously, no one wants a down round. We are expecting at least a 5x round. Obviously, every expectation in the next round is 5x to last round's valuation. So, but when it's like even a percentage lower, the investor would want to not get diluted, at least in that round. So that's valuation protection for you guys, anti-dilution rights, and confidentiality, non-binding, exclusive for 45 days. So generally in this 45 days, the founder is not allowed to talk to other investors, and because founders can shop around, can show the term sheets to others and get a better offer, etc. But this is detrimental to the investor, and we are not okay with the founder showing our term sheets to others, or none of the investor would be. And so this is why has to be kept exclusive for 45 days. And yeah, non-binding, as I stated you, and very simply date, signature, founder, WaterBridge Ventures. So yes, it looks very simple, but the SSA, same, all the clauses which I mentioned, SSA, SHA are just 200 page documents which mentions every clause in very detailed fashion, like employment agreement, founders employment agreement itself, 4-5 pages, etc. So every point has to be deep dived into. So that's how a term sheet is constructed, and I try to educate you on why investor puts those clauses and why it is relevant for them, and they will not be ready to forego it. So if we talk about maybe negotiation, which is the subject matter here, maybe the board of directors seat is obviously open for discussion. The investor wants a board of seat, but if there are two founders, maybe they can gain 3 seats for themselves. Maybe they can get a wife, and or it could be a 3-member board or a 4-member board, which is something you can negotiate. But considering negotiating that the investor should not have a board seat, maybe doesn't go well. So this could be one area of negotiation. ESOP grants. I'm just thinking aloud along with you guys, because every company will have separate requirements, and key ESOP grants greater than 1%. You can very well say that no, we plan to give many ESOP grants. Can we keep it 2%? We don't want to come back to you every time we keep giving ESOP grants, which is fair. Debt raise, maybe you can say that okay, if we are in a company of lending, we'll keep raising debt, or we are inventory-led business, we'll need to take working capital borrowings right up to front. We don't want this to be a bottleneck, which is fine. If we understand the case, we'll be ready. We'll be okay with the higher number there too. And ESOP pool, it could be lesser, but obviously it's based on the strength of the case. ROFR, we keep ROFR, but someone who keeps ROFO, right of first offer, can be negotiated down to ROFR because ROFO is very stringent. So, but we are, as I say, liberal investors, we keep ROFR itself at first place, which is generally non-negotiable. Liquidation preference is also, if someone has put 2x, 3x, you can very well negotiate it to 1x, which is pretty standard in industry. Founder vesting could be 4 years rather than 5 years. Obviously, valuation is where you have to negotiate. Haven't seen a term sheet which has come back, haven't come back saying, no, we want to value the company at a higher price. So yes, this is 100% gonna be a negotiation point. Pro rata, I don't think you should ever negotiate, which is founders, none area of concern. Whoever is investing, the founder shouldn't. In fact, the founder should want their existing investors to top up in the next round. So pro rata is something you shouldn't negotiate. And I think, yeah, broadly, this is it. I'll just open the floor for questions, but I think many of you, okay, I see some questions in the chat too. Nothing relevant for me. So I'll just touch upon one more slide, which I think is I'm gonna receive questions around that too. So this is a term sheet for a priced round. When I say priced round, is it the post money valuation is defined? So many founders will have question around convertible, safe, or YC saves documents, or what 100x VC here does for Indian investors, and Excel Atoms also does, like convertibles. So that is a plain simple document where they will reserve very minimal rights, right? Maybe just the tag along rights, maybe just the pro rata rights, etc. And the safe document typically says that we are investing, say, 100K in a company, and the valuation is left open, and it is generally decided in the next price round, like when they receive a formal term sheet where the valuation is fixed. So the safe convertibles can be raised throughout the tenure. Whenever founder needs money, they can resort to convertible structure from an angel investor, etc. No VC will typically like to get into a safe note structure or convertible structure. They like to price around. They want to know how much stake they are originally getting. So right. But angel investors shouldn't typically mind taking a convertible note, right? And because they are not even best placed to fix the valuation of the company. So the convertible note is very simple. Take the money in, and whenever right institutional investor come in, they price around, and the conversion will happen at that valuation. So maybe say 100K was invested, and WaterBridge Ventures, maybe 100K was invested a year back. Now WaterBridge Ventures came in with a 500K check and decided to value the company at $5 million. So the convertible will get converted at the 5 million valuation, and 100K will get some 2% stake in the company, right? But generally, it's at a discount to this round valuation because the investor has come in early and had taken the risk to invest in the company where there was no lead investor in place, right? So obviously the risk needs to be rewarded, and it's all investing is all about risk reward, right? So I have seen generally it's at a 20% discount or 2% discount for every month that happens. So it was 12 months. So the round happened at 12 months. So maybe they can get 2% to 12, 24% discount to the post money valuation, which is 5 million in this round. So if they get it at 25% discount, so maybe they can get in at a $4 million valuation. So their stake would be 2.5% and not 2%, right? So this is how convertibles are structured. And this is also how YC, Y Combinator also invests. YC has recently made a new investment, new clause where they invest up to additional 375K, but that they take MFN, which is the most favorable clause, right? So they just want to say that no investor will have more favorable rights than what they have, right? Which is tricky and not a plain vanilla thing to go forward to. This is just one right, but this MFN is super tricky. So, but this is a newer clause which wasn't existent till last year. So this is also which I wanted to brief you about convertibles. And yeah, I think opening the stage for questions.
Thank you so much, Naman. That was indeed a very informative presentation. I'll help you with some questions. Can you explain the liquidation preference point again? I want participants want that.
Sure. So let's assume in a very unfortunate condition that the company is winding down, and so there is $3 million to distribute, right? So obviously it's how we have studied that first the debt owners will be paid off. and then basically the creditors would be paid off, right? The trade creditors would be paid off, and whenever it's left for the equity pool, so the investor, let's assume, okay, so yeah, 3 million is fine. So let's assume there is now just $1 million to be distributed, right, amongst all the equity shareholders. So again, preference shareholder will get the preference shares before, and now when it's left to all just the equity shareholders, let's assume just 800K is left to distribute, and the founders have 50% stake in the company, and WaterBridge Ventures just 10% stake in the company. So ideally that stake would have been divided into 5:1 ratio, but no. Out of that 800K, WaterBridge Ventures will get that 500K, and 300K would be distributed under 5:1 ratio. This is liquidation preference, that the investor will get first. First, the 500K will be separated out of the company, and then equitable distribution will happen. That's liquidation preference. I hope I've answered that question for you.
Yes, I hope so too. Moving on to the next, how do you derive at valuation at the early stage with very few customers and MVP? How do you negotiate the valuation there?
Negotiation is always whatever investors say, maybe say 2x, 3x to that, and maybe come around to a common number. See, honestly, there's no head and tail to valuation. It's generally competitive benchmarking. That if a similar person in your space, similar company in the space has uh, raised 2 mil at this valuation, then why are we getting undervalued or getting a lesser valuation? So we also don't try to impose any ARM multiples or anything other than that. But typically in our stage, we have seen that it's a function of how much capital they are looking to raise, and the capital is generally what can last for like the next 12 to 18 months, and generally how much stake the founder is willing to dilute. But I've seen founders willing to dilute only 20%, which is also the ideal dilution. So if the company founders feel that it's 500K, which is needed for the next 12 months, I think that should be the raise amount, and dilution 20%, and automatically the valuation comes out to be $2.5 million. I think this is the right way to value at the early stage. For later stage, obviously there are several methods. We have DCF also when we go to the public equity. But at this stage, I generally like to value company on what's the ideal raise amount divided by what stake are they okay to value.
Okay. Up next is it necessary to do a private limited before going for an investment?
Yep.
Yeah.
It's necessary.
Okay. And yes, go ahead, please.
I think it's super necessary.
And what happens in the due diligence process?
As I mentioned, there are at least four due diligences: financial due diligence, legal due diligence, there's promoter due diligence, and there is business due diligence. Let's keep business due diligence aside because that's generally for the firm to do on their own. But financial due diligence will see if all the statutory audits have been done properly, financials were filed, there is no tax dues, because there could be liabilities which could come out to us after we come in, which we don't want. And also there is one more term to term sheet, which is reps and warranties, which we didn't cover, but we will protect ourselves from all the happenings which has happened before our entrance, right? We won't want to take care of a claim which has, or some default or some wrongdoing the company has done before our entry point, right? So in diligence, we will dig deeper. All the minutes were filed, all the board meetings are taken at the right time, right frame, all the shares are dematerialized. The founder has all the right documents, the stamp duty was placed. I'm talking about the early stage, right? I will check all the IPs are protected, the patents are there in the name, domain names are bought. That's legal DD for you. Promoter diligence, making reference checks, past calls, how they had worked in the past organizations, talking to the bosses, etc. Legal background check of the founders, etc. And financial diligence, maybe all the MIS will be studied. We'll see why the product growth slow down, increase, decrease. We'll ask questions around. So it's basically a deep dive into the business after term sheet.
Wow, that was great. Okay, I think this is in the continuation with the liquidation question you were talking. Does liquidation preference come post-step?
Yep.
Yeah. And this next question is very interesting to me too. Which part of the term sheet or which parts of the term sheet a founder should be very careful about?
Tricky. Yeah. I think the founder should look at their shares, how they are getting vested, how they are logged in, and ROFO don't agree for a ROFO, the right to first offer on your secondary sales. So if possible, try to negotiate that it doesn't have a offer to maybe just a written consent needed, or maybe just informatory purposes. You can inform the investor that because a founder gets their salary, which is also subject to contractual agreements. In the term sheet itself, it states that there will be an employment agreement, right? But in the employment agreement, how much salary will the founder draw over the years till the raise next round is also defined. So on the top of that, there is a huge value which is implicit in the stakes they hold. So maybe having the right to able to sell 0.1% stake, 0.01% stake is something someone should try to ensure and make sure that how is investor looking at that secondary stake sale.
Okay, lovely. And the next one is, say someone has raised funds from friends and family against equity. Now they want to raise the next round on convertible notes. Is this the right way to do it?
Sorry.
I will repeat that for you. Yeah, I'll repeat that for you. Say if someone has raised funds from friends and family against equity, and now they want to raise the next round on convertible notes. Is this the right way to do it? Is what they're asking.
Yeah, it doesn't really matter. Yeah, we can do that, because then the convertible will be converted based on the next round valuation. So they can definitely do that.
Okay.
But ideally, the existing investor would want to know that, because ultimately it will dilute them at some point of time, right? Every additional investment coming in is a dilution for them. So typically they would want to know. So yeah, that's the only caveat. If you keep informing the existing investor, you can raise cover.
Okay, great. Now I'll keep it a little open platform. I would ask the participants to unmute themselves, and maybe they can themselves ask their questions. And I see Mr. Murli has raised his hands. Murli, you could please unmute yourself and please go ahead and ask the question.
Yes, thanks, Ruchika. Hi, Naman.
Hi.
First of all, thanks for taking us through the entire term sheet examples. So I'm a founder of a company called Wellnesses, and we actually raised some capital through angels, through safe instrument primarily. Okay. So how does WaterBridge look at this, especially if we have defined some floor or ceiling? Would it be qualified for FFF or something else? I don't know. So I'm still not clear about it.
So for me as an investor, what caveat I see is that the founder states are already diluted. What we want, ideally, what's an ideal state for investor is that there is this founder and investor, the captain, right? But when we see there are other investors also, it highly depends on how much stake they will end up getting. If they get 20-30% stake of the company, what concerns can we have is the founder enough vested in the business or not? And also the cap table should be able to absorb more capitals, right? That's because any company which needs to be $1 billion company needs to take at least $100 million of capital, right?
Agreed.
Can people mute? So I think the only caveat is how much is getting diluted, and also the angel investor readily add value. So if for 10%, we would typically want that there is an institutional investor with some value addition, or who is sitting there. So if non-value added investors, maybe we have some concerns, but depends on the stake.
Okay. Got it. And if at all it is pretty much similar to the numbers you are looking at, then there is not a significant difference, right? So that's also good.
If you say up to 10% angel investors who say if the valuation happens this percent, they will get 10%. I think that's fine for us.
Not a problem. Okay, great. And also
we have Mr. Murli, thank you so much. We can take this afterward, and I will give the other part.
Sorry about that. Yeah.
No worries. We can always connect back. Next, Mr. Keshav Shekhawat, you could please unmute yourself. Request other participants to keep themselves mute, so to avoid disturbance.
Yeah. Hi, Naman. I wanted to ask that suppose when we go for investment raise, an industry veteran is they like our idea and they want to join the startup, but not as an investor. That's current time is not right for them, but they want to join on advisory role or mentorship role. So is it required to give away some portion of equity or not? And if yes, then how much?
Okay, it's a tough question because okay, so advisory stake, if it's always if what advice they are providing to you, right? and it has to be evaluated on the capabilities of the person you are talking about in the question. So I think that's less of a captable question, but more of your how much the input the person will, or how much what they brings on the table for the company. So if they can get you for the next round, if they ask for a 2% stake, maybe yeah, fair enough. But it could be contingent to that. Maybe it could be contingent to for the ecosystem connects they will enable. It could be contingent to the number of customers they will onboard, or the number of investors they will get onboarded, right? It could be that. So
Okay, thank you.
Thank you so much. Next up, Mr. Umesh, please.
My name is Umesh Kulkarni, and I'm running a laboratory, we are an enable accredited laboratory for food and water testing. And what I am thinking of that I have some friends or some investors. They are interested to invest, but they are not going to involve. So, is there any option that I can give them some stake for certain period? Like, suppose I am looking for to raise around 50 lakh rupees fund. So instead of going with the banks, if I can go with some investor with 20% of the stake for certain years only, after that they can I can buy back those shares. Is there any facility like that available?
sure. So I think this is where the convertible structure helps. Like rather than you diluting 20% of the stake, A is that you can just give them convertible notes that whenever there is an institutional round, you will get an equity stake. Then today it's just a paper document, right? So that is one structure that can work, and buyback can has to be discussed with every incoming investor. Generally, you wouldn't be in a position to buy back the secondary investor, or maybe in the next two rounds, some bigger fund comes in, they would be in the position to do a secondary transaction. I don't know if the company are in the position to buy back the shares with the company, because and no investor will entertain it because of the money. If the investor is putting 100 million in, $2-3 million is going to liquidate some early investor, I think that doesn't hold very so much merit for us. We want our capital, which is the primary capital, to stay in the business and to be used for business. So that arrangement is very tricky. So once they are in for life. Just and it is always an option for investor if they want to give exit to the early investors.
And I have another question. That is there any minimum size of the investment we should get, considering all other expenses? What is the minimum deal size we should go for?
So if you're doing an institutional round, at least 200K is what I will say. 200K is what 1.5 crores, at least in this market. That's the minimum if I say, yeah.
Okay.
Yep.
Okay.
Thank you.
Thank you so much, guys. We would take like up next 2 or 3 questions. Rest the questions, you can put it on the chat box. We can always send you answers post this event. So next up, Krishna, please.
Hey Naman, thanks for explaining everything in detail. It was pretty helpful. So my question is pretty straightforward. So during the pre-seed rounds, if someone raised some money and let's say they diluted X amount of equity, and what is that X amount that next stage investors looks and say, oh, they diluted so much of equity, we don't want to participate. So what is that X amount that investors normally look at and go back?
So see, I think I'll just kind of questions coming up in the chat also, but ideally from a founder's perspective, you should look at diluting 20% in every round. And it's when I say 20% in the later rounds, it will be founder and investors all cumulatively diluting 20%, or the better way to say is the incoming investors get 20% of the company, right? So that's an ideal structure. If someone has done 30%, 40% from the start, it starts pissing off the investor. So 20% is good for a founder perspective also, and for the incoming investors also. They're also happy with that kind of stake. Because let's assume if an investor got 20% and there are 4 further rounds happening, it's very much possible that till the time of IPO, that 20% is just 2% of the company, right? For the investor, incoming investor. So I think that is something which I also use as a benchmark, or also suggest to the founders. Obviously, this is my number which is derived by me, but this is also what I've seen typically.
So even in the pre-seed, 20% is
okay. Yeah. Pre-seed, see, the nomenclature is what you do, how you put it. It could be pre-seed, it could be angel, it could be seed. which is all up to you, right?
Yep.
So, but every round, I would suggest the same.
Okay. Thanks, Naman. Appreciate it.
Thank you, Krishna. Thank you so much. Next, just two more. I'll take up two more. Next up, Shashank Lumkar, please.
Hi, Naman. So this is in continuation with the advisory equity. How do we structure advisory equity in the term sheet? Per se, we have a valuation of 100 crore and we are issuing a 0.25 advisory equity. So how do we structure that in the term sheet?
Term sheet, you will have to either first, so either you first give the share from your own secondary account, like before the term sheet comes, or before the SSA, SHA starts getting developed, you already do the transaction, and there is an existing cap table which is freezed in the term sheet itself. So put there that there is already in 0.25% advisory state which we have already given rolled out. So I think this is how investors will know that there is an advising component. An investor wouldn't even mind, and they will already know that there is an advisory stake sitting in the company. So this is what I would suggest. Give it from your secondary pocket. Don't expect investor to shell it from their share, or them getting diluted even for 0.25% because of an advisory stake. So it's better get it done and then just state it in the term sheet that we already have this much 0.25% in advisory share.
Okay, fair enough. Thank you. Yeah.
Thank you so much. Next up, last one, Naman, we will take up is from Prashanjit. I'm really sorry if I pronounced your name wrong.
No worries. Thank you so much, Ruchi. Thank you, Naman. So, Naman, I think it's a very basic question. So if you're starting a startup, over there we have hardly one or two clients. So how do we, and if some investors are approaching us, so do we have a capex and opex model over there? Plus, if they wanted us to have 100% equity, so can we give it to 100% shareholding kind of thing? Although they are giving us salary and everything, are we flexible enough to do that?
Sorry, I just couldn't get it. Could you just repeat it for me?
So if we are opening a startup over there, we hardly have one or two clients initially. So in that particular phase, if some investors are eager to invest in our company, in that particular scenario, can we give 100% shares to them as well? Because they are also paying us the salary and everything as far as CEO and the co-founders are concerned.
Okay. So you are talking about giving stake to the customers?
Giving stake to the investors.
Okay. Sorry, investors.
So what happens is we have a company. Now in that particular company, we have only very few clients, one or two clients we have. So as far as the valuation is concerned, we are not a big company. So in that, keeping that scenario in mind, if our investors, the new investors wanted 100% equity or 100% share of our particular company. So is that feasible, or is that logical enough to give 100%?
But then you will work for them. They will become the owner of you. Like if you are okay with that, I think it's logical, but like, why would you give 100% of this one?
So how much? So how does that particular thing works on? Because we don't how the valuation will work in that particular case, because we hardly have clients at that particular scenario.
Okay, so if you want to discontinue that, so need to be sure that they don't have a non-compete. Generally, this is an acquisition, brother. This is not a private equity transaction. This is acquisition.
VC kind of,
so this is acqui-hire or acquisition, whatever they want to call. So you can then generally what happens, you have to be associated with the company for next 1-2 years for smoother transition, and you can't even get into competing business for X number of years, which is subject to every contractual arrangement, right? Specific. So you need to gauge that what are they typically expecting from you. You can always get away with your cash. Make sure this is a cash exit, or you don't get equity in return swap arrangement. But if you're getting your cash exit, if you think the valuation is reasonable and you think the exit is the best option, just get done with it and make sure you are watching closely on what's your contractual arrangement post this transaction, because definitely you will have that because you can start the same company with some other name and get those clients from them also the very next day, which no one would want you to do that, right? So they will protect it from some fashion. So I think this is what you should be gauging today.
Okay, fair enough.
Thanks. Okay. Thank you so much, everyone. Thank you so much to be a part of this event. We'll have to a little hard stop right now. Should you have any questions, you can reach out to him on his LinkedIn profile. I have given the same in the chat box. And thank you, Naman. Thank you so much. It was a great session. I think it was a great learning. Hoping that you have your fast forward program done very well.
Yeah, thank you so much, everyone, for being such an patient audience. I hope this helped you. Thank you so much, everyone.
Thank you, everyone.